Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we want to bring to you the economy show as a whole and really kind of break it into three specific parts. We're going to look at just what's happening with the virus and the recovery, and really looking at mobility data and just economic data across. Mostly today, we're going to look at US and Europe. And then we're going to go a little bit deeper into housing, because there's some weird or some interesting data points that kind of conflict a bit. And then we're going to talk about back to school and what does that mean for jobs and how are people feeling about jobs. And I think that's really coming out in that consumer confidence index. So before we jump into the recovery tracker, the Fed minutes just came out while we're filming. And you're starting to see some interesting components about the yield curve and what is really being talked about. And the big problem right now is what happened with the 30-year and now the 20-year auction. So the 10-year was strong. The 20 wasn't as good as the 10. It was okay. It wasn't great, just given the specific issues. But then the 30-year was fairly weak. It was the weakest that it's been since July of 2019. And you're starting to see some of this duration risk. And the duration risk is really starting to come through. Well, what will inflation look like? What should I expect to be paid back? What should real yields look like? And those are things that we're going to talk about next week when we start to kind of pick apart what does inflation look like. We've essentially experienced 10 years of limited inflation, and the velocity of money can be attributed to that. But what does it mean going forward? And those are things that I think are interesting, especially as we start to look at what does the recovery look like, and is it going to be an overhang as we all look to kind of get back to normal. So as we turn now to the recovery tracker, you can see that things have gotten a little bit better. You've seen some opportunities in terms of, again, jobless claims are now below 1 million. You're starting to see some ridership, again, as we talk about with the airline passengers in our EIA report. This is something that is going to be a headwind going forward. But the ones that look the best are mortgage applications, where that has continued to increase. The consumer comfort and same-store sales, we think, will remain an overhang, especially as we start to get into the normalcy of back to school. But again, restaurant bookings remain relatively positive, but electricity demand is a problem. And this is even coming with rolling brownouts in California. And when you look at steel production, electricity demand, I think this is where you're starting to see what does the industrial level look like. And it's going to be relatively problematic. And as we know, the S&P 500 all-time highs, yay, Fed. But let's see how this all moves, because I think only 6% of stocks are making new 52-week highs, even though the S&P 500 is at an all-time high. Go figure. So here, when we start to really kind of drill down, let's look at mobility and let's look at what people are doing on a local level. And the key components, a lot of these states make up some of the biggest driving miles when we look at the aggregate to understand what does gasoline demand look like, what does kind of that mobility look like in miles driven, and how is that really going to be impacted going forward. And you can see California, which is obviously a big driving state, remains relatively below everyone else. And it's not even just the COVID shift, but it's also the movement into work from home, a little bit more adjustments in terms of just movements. But at the same time, it's also a big tourist attraction. And what does tourism look like coming into California with people driving less? And here you can see that some of these states that had new spikes in COVID, while you can see the dip, they have started to recover, but they're still not back to those June highs. And given just where we sit in the seasonal structure of mobility, they will never really get there as we start to roll off into the fall and winter seasons. And that's where we start to look at the virus fallout. And here we turn to the Europe as a whole and the OECD economies to kind of understand those leading indicators, because we're starting to see some of that peak and roll off, specifically in Spain and Italy. Now, the problem is in Germany, because Germany's kind of giving some conflicting indicators. So as we start to see Merkel's comments, as we start to see some commentary regarding what's happening on the economy, we think that there's going to be a little bit of a slowdown, specifically as COVID has seen a resurgence. But the Bund did have a best ever auction. So there's, again, some of this conflict in terms of, well, maybe people aren't looking to invest in the US and diversify into Germany, but Germany isn't exactly a bright spot when we consider where the economy is going forward. And one of the benefits, which we talked about in our OPEC show, in our EIA show, and we'll talk about again in the OPEC show, is looking at kind of these West Coast imports, exports. And we're starting to see a little bit of a movement where things are getting a little bit better on the shipping side and the trade side, looking at exports, because Germany does have a big exporting economy. And we're starting to see some of this looseness, some of these adjustments where things are getting a little bit better. Some of the headwinds, though, Japan is starting to show some of that. They showed better July numbers, but August has so far seen a headwind really kind of driven by China. South Korea is something similar. So it's going to be interesting to see how does this materialize, especially as some of these demand numbers remain relatively soft on a global level. And that's where we look at the West Coast, because you have seen imports start to pick back up. Exports still remain relatively low, but starting to get back. And the CAS index is starting to show a little bit more appreciation within the U.S., and just consider where Germany ships. The U.S. is a big component to it. So this is something that could also indicate that, well, we're starting to see a little bit more pull specifically from Europe. But as the euro remains relatively strong, how is that going to impact total flows, which will be interesting to see. And that's when we turn to the German mileage toll tracker. And here you can kind of see where we were in terms of industrial production. You saw that nice little bounce, specifically in July, but now we've seen those trucking toll miles come back down, and they really were that leading indicator going into July. And as of August 20th, we're now back down to zero. So the idea is that you're going to see some of these headwinds, and it's going to pull that industrial production down. Now, we did get the increase, which is going to put more different product on the coast, which is going to help, essentially protect some of the exports, even though industrial production will see some headwinds as we go into September. And when we look at footfall, now this is something just kind of looking at, well, how are people going about? And you still see that we're seeing some of those pressures, specifically in the UK. And the problem is now we're starting to get an increase in COVID cases in both France and Italy, which is going to start to kind of act as a weight. But again, things have started to kind of get back to normal, but we're still averaging, based on these key countries, about 15 to 20% below normal, which is not something that is going to adjust as we go into the fall and winter season, just because tourism is down, as well as concerns as, jobs are an issue in Europe just as much as they are everywhere else in the world. And that's when we start to look at the total recovery. So not only looking at just footfall, but also investments and what is the general economy doing. And you can see that kind of weakness, and you're starting to see that roll back over, specifically in Spain and the UK. Spain had that increase in COVID, which is now back under control. So you should start to see some of that normalization, start to, drift back higher. But Germany is going to be an overhang. And so is Italy as we go through the remainder of the year. And this is what we talked about, but this is, I think, a good chart to kind of break it down, where France and Spain are crossing. France is seeing this big increase in COVID cases. And this has been something that Macron has really been focused on. Like, guys, we need to focus on keeping this stuff not spreading, be really good about social distancing. And there's only so much that you can do. And you're starting to see these spikes, which will impact the economy overall. And Germany, again, is starting to cross back up. We saw a tick higher in Germany. Again, it's something that's still early, so we don't think it's a huge issue yet. But we have to see how much did the Berlin cell really start to spread, or I should say cluster spread into the other areas, as Spain is really starting to come back off of their recent spike. And this is where, again, this is something that we've talked about in the U.S. in terms of just lending standards. And this is just showing that the ECB is no different. You're starting to see some of these loan officers get nervous about lending, and you're starting to see some of these funding conditions, general economic outlook, housing market prospects, all of these things are starting to become an issue. And loan officers are getting more concerned about what loans they're writing, what are the terms of the loans, and just what the standards are for those loans that are really going to kind of impact how does everything from not only the consumer, but also the businesses in terms of investing in their just general production, general efficiency. And this is going to be an overhang, not only for consumer spending, but also that CapEx, which is really needed to get that GDP off the ground. Now we get to turn towards housing, which has been a relative bright spot when you consider what's happening with housing starts, housing permits. Things are just up and to the right. When you look at privately owned, private house permits, you can see that there's been a healthy bounce off the bottom in this growth. And it's interesting because you continue to see people moving out of urban and moving not only into suburban, but also into rural areas. And it's going to be interesting to see what the opportunities are, which we think are extensive from energy infrastructure on down in terms of trying to provide for these housing starts. The question is going to be, now that we're also seeing delinquency rates go up, how do we get pricing? Like, is there a point where these houses are going to come online just as foreclosures are increasing? Like, how is this going to manifest itself? Especially with now that we have September lumber futures rising to going limit up to be at $783. This is something where we continue to see lumber go limit up. And again, lumber futures are typically framing. So this is going to be directly correlated to housing, home renovation, additions to homes. So this is an interesting component to how does this rectify itself. And now let's just, now that we talk about the housing starts, which clearly are very strong, continue to be strong, this is something where you're looking at delinquency rates. Delinquency rates continue to spike to new highs. Now, the difference between now and then is where you're not allowed to really start the eviction process, just given COVID, and these are things that came through in several of the acts that were passed by Congress. But it doesn't change the fact that delinquencies are increasing, not only on 30, 60 day, but also 90 day. And this is important because it puts it into perspective versus previous bubbles. And here you can see the housing bubble or the financial crisis. You can see that was when things really peaked, and it peaked at 10%. So here we're sitting at 8.3%, and we're only how many months through the COVID, whatever you want to call this, in terms of just what the impacts will be. Now, this is something when we look at it a little differently and look at those backdrops in terms of 30-60, you can see that the 90-day is actually starting to peak even more than the 30-60. And now, given the adjustments that people have allowed for banking, in the sense where you don't have to pay your mortgage or pay a smaller amount, you can get some different waivers. So some of this can be a little bit of an artificial because you're not really delinquent, you're just on a different path. And how does this move itself through? Because there's nothing's really changed on the job side. We've seen some of that fiscal stimulus go away in July. So the question is going to be, well, does that 90-day get much bigger as 30 and 60 just continue to kind of push forward? And you can see the foreclosure process remains small, unlike 08 through, let's call it 2012, and until you started to see that work through the system. This is going to be a problem when we consider what are housing prices going to do, because anybody who's been looking at the market have seen housing prices really kind of explode. And this is looking at delinquency rates versus home prices. So typically, you see the delinquency rates come down, and then that pulls housing prices lower. But now you're getting housing prices shift higher just as the delinquency rates are falling. Now, there's going to be a timing delay because the foreclosure process has been postponed or delayed. So you're going to have people that are not going to be incentivized to pay their mortgage because they're in foreclosure, but you can't get kicked out. So does this mean that 18 months from now, there's going to be a huge surge of supply just as the new build supply comes on? And this is going to be kind of how does housing prices look as we go forward, especially given just where manufacturing is, what's happening with employment, what's happening with just general economic activity to kind of support this surge in housing prices, which is going to be relatively difficult. So the first mover is the pent-up demand of people who have money living in the urban that want to go suburban. So that's your tick higher. Now, what is the follow-through? Is there follow-through as some of this new capacity comes on? And that's when we look at the U.S. Empire Manufacturing Survey. So this actually pulled back, and it was pulled back, and we'll go through the different components of what brought it down. But the positive was it did show an increase in employment. And this is something that you want to see if you start to see some normalization as companies start to feel a little bit more confident that they can actually start bringing employees back. But again, it's still not at the same level that we would hope, given where we sit in the current cycle or what we hope to be a short V-shaped recovery. And here, it's the mixture of things that have come down are going to be the problems in terms of how solidified is the CAS index? Do imports, exports really start to increase? And this is where general business conditions, obviously, but the bigger issue is the new orders, shipments, and unfilled orders. So the new orders came back down. It's now negative if you consider what the expectations are, where July was a growth of 13.9. August came in at negative 1.7. So that's a change of 15.6, which is going to be a problem because that's indicative of future work, of future production, and we're just not seeing that carry through. And again, that's also showing up in shipments, where shipments are still going out, but it's well below July. August is slower, and realistically, as you consider the fact that people aren't buying as much, back to school isn't the same, which we'll talk about in a minute. These are going to continue to weigh on just kind of what things look like over time, and it's going to be hard to see some of this manufacturing really kind of get back to normal. But employment was a bright spot. And as we start to turn into, okay, well, what's going to happen going forward? We're seeing all of this money get pushed into the market, but we really haven't seen inflation the way we were thinking we would. And here's an interesting breakdown in terms of what the stimulus looks like and what the government has to borrow, which comes back to our very first point about the 20-year, 30-year, and the 10-year, just looking at what's happening on the borrow level. And we're starting to see less and less demand for some of the longer dated bonds where the 10-year remains strong. So that's more of like a steepener. And here's kind of why. Like, there's more stimulus coming. There's more borrowing coming. There's more of a shortfall to pick up, and coming back down to the manufacturing index and some of these other industrial production indexes. Tax revenue is going to be a problem, and if you don't have tax revenue, well, then in your lending, you're going to need to borrow from someone. So this is going to be problematic, but the Fed has tried to take some of that off of people's hands. The Fed continues to be a buyer. The foreign holders of treasuries continues to come down, and they're just selling it into the treasury. And you have to consider, well, why would they do that? Well, I'm not going to borrow against my treasuries. I'll sell my treasuries, pull forward the dollars, take delivery of the USD, and then use that to shore up my balance sheet when you're thinking about foreign reserves and trying to create some stability, because we've seen inflation continue to tick higher abroad. So, because even though the US dollar has fallen in terms of value, it's actually 96 out of 144 currencies have fallen further. So you kind of get an idea of the issues abroad. And this would just allow to kind of that pull forward some of those dollars to provide some semblance of support, especially as the Fed's the buyer. Why not? So here is kind of the 10-year, 30-year curve. So when you look at the U.S. budget as a percentage of GDP, you can see as the budget deficit increases, typically you start to see the curve follow it, because now there's a risk about, okay, well, you're borrowing, so you're going to borrow more, so there's more risk, so I'm going to need a higher interest rate, because now I'm concerned about inflation and some of this duration risk, which is being priced in. Now, when you think about, okay, well, as the curve starts to see that steepening, well, what's really driving it? And it's the first time that we saw core inflation jump in July. It's the most since it's jumped before, but I should say it's the most it's jumped since July 1991. Now, consider where that pricing pressure is and where the pricing pressure continues. And yeah, that's where you have to consider the Cantillon effect, which is when you look at the entry point of the money. Right now, it's going to banks. Banks are getting the capital, but we've all talked about constantly over the last 3 weeks, and again today with the ECB, how lending standards are going up, which means that banks are lending less. So if banks are lending less, then they're not getting it to the consumer or the corporation. So how do you do that? Well, does the Fed shift the entry point? And then that's when you could start to see inflation become a fear. Not saying they will, but again, it's something that you have to consider when we're looking at inflation. If they have a 2% target and we're sitting here at a relatively high core inflation number, but not the target number. So how does that get rectified? And anybody that spends money can attest to the fact that inflation is up across the board for anything that you want to do. And as we talked about with housing prices, as we see with lumber, and it's starting to kind of materialize in different ways. And that's where you start to think of like, well, why isn't it accelerating the levels that we expected? And this is when you look at money supply year over year, and you consider about the fact that the supply has gone up exponentially, which we've seen. The Fed has printed trillions of dollars, but the velocity of money has gone down. And the velocity of money is going down because banks aren't lending. So you're not pushing it into the market because you have a bad debt expense that you have to cover. So it's sitting on balance sheets. It's going to support the euro dollar, or it's, which is just going to sit on foreign entities to secure their balance sheet, to secure their inflation levels. And you're just not seeing this cycle through. So this is going to be a problem which could get rectified relatively quickly if you redirect the entry point of the money, and or you actually get a default on a global, looking into emerging markets where they no longer need to keep so many dollars on their balance sheet. And then you get a wave of money coming back that has to be absorbed within the US. Again, interesting things to look at. And this, to round it out, when we look at U.S. inflation policy and bond yields, you can see that everything has been that goes down and to the right over the last, 15, 20 years in terms of just where we've been. We've been in a bond bull market for 10 years. The question is now, is the cycle changing? Are we starting to see the cycle shift the other way just because we've maxed out the amount of borrowing, we've maxed out the amount that we can pump up the economy, and we've had this easy policy for so long that now we're going to get overinflated and you're going to start to see some of this heat up. Now, these are questions where clearly we're not there yet. We're not even really indicating there yet, but you're starting to see that softness come into the 20-year, 30-year, and these CPI inflation numbers. And this is something that we're going to look at, especially as we're not out of the woods in terms of restarting the economy and getting things back to normal, because jobs are still a problem. There's still a problem abroad, which is going to be the economic headwinds that some of these governments and central banks are looking to try to inflate and or stimulate. Now I get to talk to you about a painful topic that hits me in the face every single time I go home. And it's what are we going to do with my kids? What are you going to do with your kids when it comes to back to school? Everybody has gotten their pamphlet. Ours was 22 pages with frequently asked questions and what happens here, what happens there. And the short answer is there is no answer. There's contingencies, there's some plan, but the question is how stable is it? We've seen Notre Dame have to pull back from their in-person because they had a COVID spike. UNC had the same issue, just looking at what things have happened near term. And here you can kind of give a backdrop as to how America's school districts are starting the academic year. You have 48%, which are remote only, 28% full in person. My kids are in that 28%. I'd love to know how your kids are. Hybrid, which is typically you break it into segments where you have 1A, 1B, and you just break them into one is remote while one is in person, and then you switch. Who knows if it's going to work? But again, these are issues that are going to continue to crop up. How do you get, do you need childcare? Do you need food subsidies, just given where the problem is, because kids rely on this for food. But how is this going to work? Do kids really learn any better online? Do they not learn online? There's so many unknowns, and this is going to be a huge sticking point. I know it is in my household, so I'd love to know how it is in yours, because I know that this dominates a lot of dinner talk in terms of what happens next, because this is really what things are going to look like on a go forward level, and to focus on it a little differently is the amount of kids that require the food. You look at the share of adults with kids at home who are saying they can't afford enough food for their kids. I mean, school was essentially a food program for a lot of these individuals. Like, I have friends that talk about how they would bring extra food in for some kids that were, when they were kindergarten, first grade teachers, because you could tell like that kid's going to go home and not really sure that if there's dinner going to be on the table. And here you can see it in plain percentages that continues to grow. And it's really driven based on not only food inflation, which we've been talking about extensively, and is starting to finally show up in some of the inflation numbers, but also employment. What are people do? What is happening on the employment side? And that's when we start to look at the weekly initial versus the continuing. And now, while you've seen weekly initial fall below 1 million for the first time on a 4-week moving average, it's still hanging above that 1 million. But again, the continuing claims remain sticky, and it's very unlikely to see a lot of this change, especially as we start going through the remainder of the year. And the reason why we can say it's unlikely to see a huge shift is just looking at, well, what are job postings doing? And here you can see job postings. Like 2018 was a growing year. 2018, things were moving. PMIs were positive. GDP was up. There was expansion, and you could see that reflected in the numbers. 2019 was a little bit slower, which again, you see that reflected in the numbers. And now 2020, even though we've seen the talk of expansion, you've seen employment change a little bit, you're just not seeing kind of that gap close where we're still 20% off of 2019 in terms of job postings. So even though you have this huge, essentially employment base to pick from, it's just there's not the job openings, and it comes down to lack of CapEx, lack of concern about future business endeavors. As we talked about last week in our small business segment, small businesses are concerned, and their one person is meaningful to their bottom line. As you see a lot of the big entities, the Fortune 100s, 500s, essentially announce large layoffs, so which is going to continue to weigh on total job postings. So, you marry all of this together, and what do you get? You get a weak consumer sentiment, because people are looking at this and saying, well, I don't know what the future looks like. My kids may go to school, may not go to school. I may not have a job. I may have a job. Maybe I'll find a job, not sure. As you start to see this concern about kind of where things are going forward. And this is where it all is kind of coming and culminating, where we're now back down to the April's pandemic low, but at the same time with the index of consumer expectations, we're now to the lowest since 2013. So not only is sentiment getting shifted lower, but also future expectations are falling. And this is starting to weigh on people who have now been unemployed for more than 6 weeks. Like when you're unemployed for a month, it's okay. It's growing pains. I'm going to use my network. I'm going to get out there. I'm going to pound the pavement. 6 weeks, 8 weeks, 12 weeks. Now depression, concerns, all of these things start to come in, and you start to change the way you spend, the way you view the world, the way your concern is going to be. And then at the same time, you may have let bills pile up. So even if you do get a job, is it at the same salary or a lower salary? Is it going to take time to crawl out of the hole that you got into because of the debt you needed to just operate your life, provide for your family? These are very difficult questions that are just not being answered as the Fed tries to pump up the market and the S&P hits all-time highs. These are real economic issues. And again, you have to separate. There's the market and the economy. Eventually, the two shall meet. The question is, based on what we've seen, is it enough to justify where the market is? And I would say no. But again, liquidity is in the market, as we've seen with the growth of M2, and it has to find a home. And so far, it remains mostly tech at this point. But again, these are the real economic pitfalls and issues that we're facing going into a key election year. And what is the stimulus going to look like? Because now the Democrats have said they're going to cut in half what they were expecting, and they're willing to make a deal just to get something back into the market, because the August numbers are going to be soft as we have that limit on the additional subsidies, and people face tightening their belts as their kids go back to school. So thanks again for watching. Coming up the rest of this week, we're going to have our OPEC Plus update. We're going to have a Three Gorges Dam update, and then we're going to have our favorite, the Primary Vision Frac Spread Count. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.